Hello everyone, good afternoon. Welcome to the Tech Gig webinar on how is blockchain disrupting trade finance. I'm your host Sukriti. Thank you so much for joining the session. So folks, today's webinar will delve into the game-changing landscape of blockchain technology in trade finance. We'll explore three main themes: traditional trade transactions, why blockchain matters, and the interplay between central bank digital currencies and the trade finance blockchains. This webinar will also discuss industry examples and practical insights into how blockchain addresses common trade challenges such as counterfeit documents, sluggish payments, and opaque supply chains. Our guest speakers today will also unveil the impact of smart contracts, computerized agreements that streamline trade by eliminating intermediaries and reducing the likelihood of disputes. As we unravel the relevance of blockchain, we'll also examine the potential to reshape traditional trade models, opening doors to benefits like increased financial inclusion, cost reduction, and accelerated cross-border transactions. Folks, please join us as we are ready to demystify current trade problems, shed light on how blockchain can address them, and share insights into what lies ahead. And to facilitate the session, I have with me two speakers from Maveric Systems India Private Limited, Yogesh Gadebali, who is serving as a senior consultant at Maveric Systems, where he's associated since 2010. His extensive experience serving banks demonstrates a compelling leadership history spanning diverse domains and global landscapes. His extensive expertise encompasses retail, corporate, Islamic banking, and wealth management domains. Our second speaker, Vivek Mohan, is serving as a consultant at Maverick, and he carries over 13 plus years of experience in trade finance, serving as a domain specialist to deliver trade and treasury engagements for leading banks. His key areas of expertise are handling everything in trade finance, from multi-insurance to payment, transfer, collection, and guarantee. Now, without much ado, let's take the discussion forward, and I'm going to hand over it to our guest speakers for today, passing it on to Yogesh. Over to you, Yogesh.
Many thanks, Shukriti, and thanks for that wonderful introduction. So, my colleague and I are really grateful to be on this platform and speaking to a wide, larger crowd. Thanks for this opportunity, TechGig. And to introduce our company, we are about 24 years old, rather young, and we primarily excel in the area of banking domain and technology, and we have our primary strength is our expertise in banking domain. And we have done so far 85 plus banking transformation, and we have presence in 3 or more continents. We have a global employees strength of 3,000 plus, and year on year we are growing at 30%. So this is about our company. Right. So most of you would be intrigued. Why would a 16th century Shakespearean play finds in the scope of our discussion today? I promise you, I will make sense of this slide and everything will play out. Please bear with me. So we know the Merchant of Venice is a Shakespearean play. So without giving too much away into the story, I would urge you to read this play at your leisure. Basically, one of these characters secures a loan from another character, Antonio and Shylock, and there is a pledge for a pound of flesh as collateral under specific conditions. So Antonio anticipates the repayment upon the arrival of his ship. So he's a trader and he's awaiting some ships to reach the store. He would sell the produce and repay the loan to Shylock. However, due to unfortunate circumstances, Antonio's ships do not reach the shores. It sinks. So he fails to meet his debt obligations. A legal dispute arises between Antonio and Shylock. And Shylock seeks to enforce the collateral, meaning he wants to take that pound of flesh. What is very important in this particular story, which is a 16th century, I am underlying the word 16th century, is the way trade used to happen. There is not much change till date today. I'm sure the underlying philosophy of cross-border trade, intercountry trade, remains the same right from that original inception of this play. However, no banker is asking for a ridiculous collateral like a pound of flesh. Somebody might think they would go for the soul. Just kidding. So the theme of our discussion is cross-border trade. So I would like to urge you to pay attention to the upcoming slide. For example, there is a company called Templeton Boiler Company, which is based out of London. It is looking for cost-effective nuts and bolts for its new boilers. So then there is a company who supplies these nuts and bolts called the Patel Precision Engineering. Both of them don't know each other. There are trust and payments and security issues for both the parties. They are into the questioning of what if he doesn't pay, what if he doesn't deliver, what if the quality is not so great. All those questions are there. So we would like to discuss in our first part how such trades are carried out using trade finance solutions, which is current day, right? Now we have come a long way from the Merchant of Venice play, like 16th century. We are in the 21st century. So how trade finance is happening in this current situation? And another case is also something intriguing. I would strongly urge you to keep this in the back of your mind, which is crucial to our discussion. So the case 2 is Johannesburg municipality invites tender to construct a new community center in one of its upcoming suburbs. Numerous contractors, including a contractor from India, Vishaka Constructions, have submitted bids. Right? Despite Vishaka Construction offering the lowest bid, the municipality is apprehensive about the company's credential and the construction quality. For we know most of the local suppliers of local customers of Vishaka Constructions, they know that Vishaka is the best construction company offering great value, right? However, this might not translate into goodwill to Johannes municipality, which is a long way from India or the geography that Vishaka is operating in. In a real world scenario, how such concerns are being typically addressed. So the key takeaway of this entire discussion is how traditional trade finance in today's scenario works, why blockchain matters and how it could disrupt the traditional trade finance, the nuances of traditional trade finance, and over and above that, in the future, how could CBDCs can play an effective role. So both these two scenarios are very much applicable to our discussion. And with that, myself and my colleague will make an honest attempt to ensure that you audience take this away as part of this seminar. And I'm now passing on to my colleague, Vivek.
Thanks, Yogesh, for the wonderful story. So, guys, so post this discussion, right? So you'll be knowing what is trade finance, and what is blockchain, and how does the application of blockchain is having an impact on the traditional trade finance, and interplay with the CBDC and blockchain. Fine. See, let's understand what is trade, and we will understand what is trade finance. The trade, in generic sense, it is exchange of goods and or services. Okay, so when we have a surplus, then we will export goods, and when we have a deficit, we import goods. So as you can see in this slide, the one precious metal which we like to hold more is on gold, right? So we import gold, and globally we stand at number 2, and China is the number 1. So trade, in simple terms, it is exchange of goods and services, and trade finance is a collection of financial instruments which facilitate a trade between exporters and importers. So that's how the difference between trade and trade finance. This basic definition must be clear in your mind so that we can proceed to the next topics. Okay, on the potential, right? the potential of trade finance in 2032 is targeted around $12.5 trillion, and with a compounded annual growth rate of 3%. And out of which the confirmed LC market share size is around $5 billion. That is the volume of LCs in overall international trade. Yeah. So we have different parties in international trade, right from exporters, importers, banks, shipping companies, insurance companies, export and trade credit companies. So multiple parties are there in this international trade. So the reason why we have discussing this point is like because we have multiple parties and each party is working in silos. So we'll be explaining what is the demerit of it and how we can overcome all these issues with the blockchain technologies. The basic products which bank is offering in trade finance is we have three basic products, that is LC, documentary collections, and guarantee. To keep it simpler, documentary credits are like banks guaranteeing buyer's payment to seller, and collections, here bank's role is limited when compared to LCs. Here what the bank's role is on the forwarding documents and for the collection of payment. And guarantees, in case of default, bank will pitch in and they make payment. These are the basic products which you have to keep in mind, because we will correlate with the case study or with the examples which Yogesh has told along with these products. So case on one, right, on the importers buying cost-effective bolts. Since both the parties doesn't have any interaction earlier and they don't trust each other, the basic or the best example over here is on LCs. Usually exporters and importers will go for LCs when they don't know each other. That is the best payment method which they can use. If in case these two parties, they are very well known, they have already traded between exporters and importers, it's been done for so many years, like 3-4 years, and they are very comfortable, and they'll be going it for collection method. And guarantees, there was a Johannesburg case study, right, which Yogesh has mentioned it. If in case the Vishaka entity doesn't go for the performance of the contract, they here bid one guarantee will be there. That is the classification how the same case study can be used for a letter of credit, collections, and guarantee. Now we will be discussing on the basic workflow of LC. See, here the life cycle starts from buyer and the exporter. Step one will be the sales contract will be established between the buyer and exporter. Once it is established, then the importer will come to the issuing bank and they will be requesting for an LC application. Post which, after scrutiny is done on facilities setup has been done, issuing bank will be sending MT700, that is called as letter of credit, to the advising bank. What the advising bank does, the advising bank will check for the completeness of the LCs, and they will check for the basic workabilities, post which this LC will be advised to the beneficiary, who is the exporter over here. Once the exporter gets the LCs, what he will do? He will check the LC terms, whether it is matching with the sales contract or not, post which there will be he'll be presenting the documents to the advising bank. Okay. Now the same documents will be forwarded to the issuing bank also, and issuing bank will check the documents after 5 banking days as per UCP 600, post which the fate of the documents will be decided, whether it is a clean document or a stipend document. Then the payment will be released. Once the payment has been released, the documents will be released to the importer, after which the importer can go to the ports and he can take delivery of the goods. See, here we have numerous documents to be presented by the exporter: shipping documents, insurance, and commercial documents. So we will come to this later, because usually, right, the traditional trade finance involves many physical documents, which is one of the pain points has to be addressed by using the application of blockchain technology. Yeah. So these are the sample documents: bill of lading and invoice. Why we have kept these two documents? Because these are the basic documents. Whenever the goods has been shipped, the price details will be mentioned in the invoice, and the title documents is on the bill of lading. So we have different settlement method, guys. So over here it starts from the cash in advance, letter of credit, collections, open account, and consignments. We have these many payment methods is there in traditional trade finance. Will be taking care of the LCs. How blockchain technologies will have a positive impact on the traditional trade finance. So now we'll be discussing on what are the challenges in trade finance. As I told you, there are numerous documents to be presented by the exporter, starting from the commercial documents, shipping documents, and insurance documents. And the persons who are already there in operation, they might be knowing whenever we get the documents from Bangladesh, the documents will be very bulky, and it will take so much time. It will take so much time on processing these documents. 1 minute. Yeah. Okay, on cost wise, right? This the traditional trade finance will have a cost around 1 to 2% of the transaction cost. On time delay, the average processing time for issuing LCs stands around 1 to 2 weeks, and the time gap between the document presentation till payment will be around 10 days. And since these are all physically paper-based documents, we have a considerable time in transport of documents from each parties, that is from the beneficiaries to the advising bank, and from advising bank to the issuing bank. Once again, these documents has to be forwarded to the applicant also. So these many roles are there. The documents has to flow via courier, and this leads to the increase in cost, as well as on the efficiency has been reduced. On visibility part, right? Since I told you there are many parties are involved in the LC flow. These parties are working in silos, which means that they are not interacting with each other. Okay, see here, as per the survey done by the Trade Finance Global, you can see they have mentioned like 66% has already mentioned the issues is with paper-based documents. And as we already discussed, high cost, longer settlement time, low authenticity, and the lack of trade movement visibilities is the major pain points which we have in the existing trade finance. So now we have covered what is trade, what is trade finance. Now we'll be checking what are the why we should know about blockchain technologies. The reason why we should know on blockchain technologies, like only then we can appreciate on the application of these features in the traditional trade finance, and how does it impact on the challenges for which we already discussed. On potential part, right? So on 2032, it has been projected around 334 billion US dollars is the market size of this blockchain technologies. And in India, more than 50% of states is already involved in blockchain initiatives. Yeah, fine. So now we'll be discussing what are the various properties in blockchain technologies. So these properties are utilized for overcoming the challenges in trade finance. So first property is on it is a distributed ledger. The reason being that ledger is distributed across nodes, and all these nodes are interconnected, and they are all synced up. So there is no mismatch on the entries, and this that is the reason it is called as distributed. And why it is called immutable? Because each block. So we'll be discussing what is blocks and all, but as of now, keep in mind it is immutable. Because, immutable in the sense each block is interlinked with the previous block, and there is no way to tamper with the data. That is the reason it is called as immutable. And each transaction is being timestamped over here, and all the participants or nodes in the blockchain network, they have to validate the transactions. So it is not a unilateral way, or there is no central party who is taking care of this validation of transaction. Each nodes will be validating transactions over here, and it is a trusted one because the data transfer is among the nodes are transparent. So each party knows what is happening. And why it is secure? Because of the hashing method, which we'll be discussing in later. But whenever there is a tamper in data, there is a drastic change in the output values. So every node participants will be knowing what is happening over there. And the most important thing is on the smart contract, because this helps in automation of transactions in the blockchain. So now we'll be discussing a bit technical on the blockchain. The reason being, only then you can appreciate the application of blockchain technologies in solving the challenges in the traditional trade finance. So now we will start with the nodes. Then we'll be ending with what is blockchain and how does it blockchain works. So here, each the transaction, right, they initiated by the participants, there are over here, they are called as transactions. But these transactions will not be passed on to the ledger automatically. They'll be batched as like in NFTs. They'll be batched and grouped into blocks. Once this blocks is validated by all the nodes, then it gets added to the blockchain. That's how it works. And why do we call it as a blockchain? Because each block is hashed over here, and the next block is having a link with the previous block. So it is called as blockchain. That is very simple. Okay, now the nodes, right? So we already discussed there are various participants in the trade finance. So each participant in the blockchain network is called as nodes. So now we know what is a node, we know what is a block, what is a blockchain, and how does it get added to the blockchain network. Here you can see the functional flow of this blockchain, starting from the nodes who is requesting for the transaction. Once the transaction has been initiated, all these transactions will be propagated or broadcasted to the nodes across in the blockchain network. These transactions will be batched into blocks, and these blocks also will be propagated across nodes, and it will be added to the blockchain network. So we have a consensus mechanism. So the basic, we have two types of consensus mechanism. One is on the proof of work and proof of stake. Here, the proof of work is based on the computational power, whereas the proof of stake is based on how much stake we have in the blockchain network. And on hashing, right? So why do we do hashing? It's like WinZip method when we have what we have in the real life scenarios. Here, the data is being compressed using the hash algorithm. We use ECDCA method in Bitcoin for hashing. Now we'll be discussing what is the difference between the distributed ledger as well as on the centralized ledger. Centralized ledger, we all know, banks is the main central party or authority over here. But in distributed ledger, there is no central party over here. So all the nodes, they have a function of validating the transactions, and all nodes will manage the network over here. So we have to keep in mind the blockchain is only a subset of DLTs. We have other DLTs in place like blockchain, hashgraph, DAG, holochain, and Radix. Keep in mind, like Radix is the last one, but holochain is rightly emerging, and it is more decentralized when compared to blockchain. So to put it in a nutshell, so we use private keys, private and public keys for initiating and broadcasting transactions, and proof of work and certain alternatives like proof of stake, which we already discussed, will be used for validating transactions. And hash function is used for chaining the blocks. And over here, on the cryptography, I need to touch upon. See, the cryptography is a technique of encoding a message, and we have two types of cryptographies. One is on symmetric cryptographies, and we have asymmetric cryptographies. Symmetric cryptographies, we use the same key for both encryption and decryption, whereas in asymmetric cryptographies, we use two different keys, but both the keys are linked each other mathematically. That is the basic logic over here. And here, using the private key which we have, we can generate the public key using the algorithm. And on hashing, as per it's a digital digest of data, which you can use it for compression of data. The industry standard over here is MD5, is message digest function, and we have secure hash algorithm, that is SHA-256. So the major types of blockchain, we have two basic types. One is open and second is on the closed. In open, there is no permissions required for joining the blockchain network, whereas in closed network like R3, Corda, Contour, so there is a permissions required to join to the network, and data is shared only among the participants or among the nodes. But in open networks, it's not required to get a permission to join the network. An example, we can say it as Ethereum networks. So now we will talk about smart contracts. This is the most important the concept which we have to discuss over here, because it helps in automation of the transactions in the blockchain. So here, when you go to the origin, Nick Szabo is the person. He's a computer scientist who invented virtual currency long before Bitcoin itself. It's called as BitGold. And in 1994, he's published a paper. And over there, he defined the smart contracts as a computerized transaction protocol that execute the terms of the contract. Keep it simpler on definition part. These are codes. These are self-executing codes which will get executed in the blockchain network once the conditions are met. So how it is executed, as I already told you, once the business logic is being met, these conditions are satisfied, then the smart contract will get executed. A basic example which you can say is a vending machine, and this example was quoted from Nick Szabo in his paper. And this is a very beautiful example, guys. You have to understand so that you'll be able to understand the functionality of the smart contract. It's called as the vending machine. As we all know, how do we operate vending machine, right? These vending machines, here the rules are stored, the rules are verified, and it is auto-executed. Simpler example to understand the smart contract. Yeah, fine. So here the coding which we use in the smart contract is the Solidity language is based on the JavaScript. To keep it simpler, like it is in the code will be written in the sense like if this condition is satisfied, then the statement will be executed. That's how it is. Simple it is. And we have 4 life cycles for understanding the smart contract. The first stage will be on the recording of the terms of this contract, or codifying the terms of the contract into the smart contract. We are programming into a code, post which we are connecting these programs either to the internal systems or to the external systems. Usually we call it as oracles. So they'll be listening to events. If there is any change in events, then what happens? These contracts will smart contracts will check whether the events will match with the conditions already there programmed in the smart contract. If it is matching, then they'll be self-executing it. So we have different applications in smart contract. It will be applied in payments. It will be applied in documents, exchange of document title, as well as in exchange of goods. Like for payments, what we can see, whenever the goods reach the port of destination, the payments will take place automatically. And on document issuance, right? What happens when the goods are loaded on board? The document is issued automatically. That is the exchange of the issuance of BL will take place automatically. And on exchange of title of goods, what happens? Usually when the payment is exchanged and the shipment will be the title documents will be exchanged. Here both the transactions can be automated using smart contract. Yeah, now, so till now we have been discussing what is trade finance, what are the challenges in trade finance, and we've been discussing on the technology part, what is blockchain and the concepts in blockchain. Now, what happens? Now we merge both the features of blockchain to the addressing whether these challenges which we already have in the existing trade finance can be addressed in blockchain or not. Yeah. So we already discussed on the basic workflow, how the LC will be functioning. Just to reiterate once again, letter of credit is a guarantee which the bank is having cushion in order to confirm the buyer's payment to the seller. On the functional flow, this we already discussed over here, starting from the sales contract till payment. So we have these many parties enrolled, and since each party is working silos, we already mentioned, this takes time and there is no visibility over there. So now the current structure is every party is working in a sequential manner, and there is no visibility over here. Post deployment of blockchain, all the nodes or all the parties will be interlinked, and they'll be knowing what is happening at any point of time, and whatever data has been initiated, all the parties will be knowing what is the actual state of it, and even on the flow of information as well as on the goods also, where does the goods lie. So now this is a pictorial representation of post implementation of blockchain. So we already see, right, what is the functional flow, the sequential flow of LC cycle. Post deployment of blockchain technologies, all participants, all nodes will be interlinked, and they know each other. What is it? What each party is? What is the type of data which each party is sharing? So we have these many prominent DLT technology service providers: R3 Fabric, Ethereum, and Quorum. We already discussed on different major types, right? Open networks and closed networks. Ethereum falls under open network, and Quorum falls under closed network. So here, the normal traditional LC flow, which we already discussed, right? So here, Hyperledger's Fabric framework with the implementation of the smart contract, this life cycle is taking place, right from there is initiation of the smart contract till shipment confirmation. Everything is being integrated over here using this blockchain technology along with the application of smart contract. So we have these many prominent trade finance blockchain networks. So now we'll be discussing the two case studies. One is on Wave networks, second is on the India Trade Connect. So on Wave network, here the importer was facing existing challenges, like for issuing LCs, there was so much time is required for issuing LCs, and it's a complex method and many approvals is required. And post deployment of blockchain technologies in trade finance, and here all these existing challenges has been resolved, and the customer can see major benefits because due to the implementation of blockchain in the traditional trade finance. So how it is implemented? So there are two main things. One is on the using shared ledger. Second thing is on the using smart contract. Shared ledger was used for storing all the documentation. So we were seeing, right, in the earlier slides, there are three major documents like invoice, bill of lading, insurance documents, phytosanitary certificate. We have many documents in place. The documents has to be presented by the exporter. So all these documents were digitized, and it is uploaded in the blockchain network. Since it is a shared ledger, all the nodes, they were able to access the data real time, and there's no delay in it. So what happens in the normal flow? Exporter will be presenting the documents via courier, and it will be reaching to the advising bank. Once again, the advising bank will courier these documents to the issuing bank. Once again, these documents will be couriered to the applicant. So these many challenges, like because in courier, right, what we face, there are two things. One, either documents can be lost, or the documents can be held up in any certain manners. Like we saw a scenario in COVID times, 7,000 articles was held up in Chennai head office. That is the impact of existing trend. But now in blockchain, since all the documents are digitized, so each node, each participants can access these documents online, and it's not required to courier these documents. That is the most important thing which you keep in mind. And here, by using smart contracts, what we can do, we can automate the transactions from issuance of BL till payment also. So because each trade life cycles, we have different events, and all these events can be automated based on the conditions which we set in the smart contract. So what are the benefits we have here? Post deployment of blockchain technologies in the traditional trade finance, 5% of the cost involved in handling documentation is saved over here. And on the timelines, usually it takes 2 to 3 weeks for issuing an LC. Now it has been issued within hours. This is a great way of utilizing this blockchain technologies in traditional trade finance. And as I told you, there is no the courier involved, so the cost and time is reduced. So this how, guys, like how do we ensure these features of blockchain to have a greater benefit in the traditional trade finance? Yeah, on the case study B, now this is on the trade connector. So here it is based on the API interface, which means like it's not required to make any huge changes to the existing infrastructure. So we can integrate your existing system with the using an API call. That's how simple it is. And the type of network which is used is the consortium. It is a hybrid between there are more than one major participants will be there in a consortium. That's how it is. And what are the existing challenges which we have over here? So here it's a slow process in inland LCs. The product over here is on inland LCs, and it's a paper-based documents involving many entities over here. Those are the common challenges which we have. And here, most important thing is like usually either in inland LCs or in overseas LCs, we have issues of fraud happening. Either because the same BL can be presented with 2 different presentations, and the customer can make a drawing over there. So that is one thing. And in supply chain finance, the same invoice also can be presented. But these can be overcome using blockchain technologies by hashing it and by using digital signatures. So now over here, what are the operational benefits we have? So here, as we already discussed, the processing time of LCs has been reduced from 8 to 9 days to only 2 to 3 days, which is more than 80% improvement. And operational risk mitigations, or the invoice and purchase order received on the platforms are uniquely identified, as I told you now, and they are stored in the blockchain. So there is no way of making a fraud, like using a same BL for presentation with the different banks. But all these banks has to be there in the same network. That is the most important point. If in case this process is getting extended out of the closed network, then which means we have to follow the traditional method, which we'll be discussing on when we come to the challenges part. And cost reduction, the courier fees and message cost is reduced over here. And visibilities, since all the parties are there in the same network, and the data exchange between the networks is visible to everyone, so transparency is maintained, and there is no silos, or there is no issues that we're not able to trace the status of the messages. Yeah. On current updates, Citibank has already completed blockchain-enabled LC transactions on Contour network for its Cumin India Limited. On 31st August 2023, SWIFT completes a blockchain interoperability trial with the BNP Paribas, Citi, and DTTC. Yeah. So now we'll be discussing on CBDCs and interplay with CBDCs and blockchain. My colleague Yogesh will be taking over now.
Hey, thanks. Thanks, Vivek. So, in a nutshell, with the examples my colleague was quoting from the original setup that we did, one, a boiler company who is trying to trade nuts and bolts with a precision engineering company from India. And there is one municipality who is already is looking for a construction company to build its community center. In both these cases, you have different types of financial instruments, which is already available in the market. And those financial instruments are now being traded on blockchain. Most of these blockchains are either in pilot modes or POCs. Some of the trade finance blockchains, the examples are quoted, those are similar pilot projects where the banks are testing feasibility studies. Similar is the case with CBDCs as well. Almost 138 countries are in various stages. Some of them are in research and development stage. Some of them are in pilot stage. There is just POCs and pilots which are being done on CBDC. Before delving into the details of CBDC, we can appreciate how trade finance blockchains can eliminate the need of digital documents. When we say digital documents, it is not scanned images of paper, authenticated, adjudicated by the node themselves. If the quality agent is one of those nodes, the buyer can be rest assured that the quality of the product which is about to be shipped is already authenticated, adjudicated on the node, and thereby everybody knows that the quality of the goods transferred is of the best quality. Similarly, the shipping agent will also know what type of goods is being exchanged from one country to another country, and the title is very clear. Instead of exchanging images of paper or the real paper, we are having authenticated contracts between the parties. Most important part in understanding the CBDC, because both of are similar nature, at the same time they are also dissimilar. Let me explain you why. Central Bank Digital Currency is a digital currency, is the fiat currency issued by the sovereign authority of the country. In India, sovereign central bank or the sovereign authority of the country issues a digital currency. It is the equivalent of the paper currency if any country prints. It is only in digital form. The CBDCs are directly distributed in two parts, either in retail or wholesale. Wholesale to the banks for any interbank transactions. Retail for people like you and me, where the sovereign authority or the RBI, or in our case, or any central bank can issue currency for circulation, right? So CBDCs work on blockchain-based networks, right? Distributed ledger technologies, and similarly there are many cryptocurrencies which are already there, which is not backed by any sovereignty. But CBDCs, leveraging the flexibility of what cryptocurrencies offer, with an added advantage of regulation to its place, central banks are thinking of, in some cases, they have issued CBDCs are in circulation. Various the self-interest of the central bank is that the transparency, unverified actors can be identified. Lot of the intended purpose of that supply of money can be met, better monetary regulation, and these are preventing anti-money laundering activities, right? So these are various self-interest for the central government. However, it's more than that. We would like to explore why. Like I said, a typical characteristic of the CBDC is it's a modern form of digital money issued by central banks, wherein from an user standpoint, the banks, the digital money that you hold in wallets are not truly, in a sense, digital. They are merely your money kept in an intermediary, such as a bank or a financial institution, wherein digital money issued by central banks are just like notes which can be exchanged for a value. It offers high trust, security, and stability akin to a currency. However, it is more than that. It is traceable. It can be source of funds can be easily ascertained, and it also offers a lot of stability in terms of the price. Issued directly by the central banks, not subject to private bank risks. For example, if the money that you hold in a bank such as a hold in an intermediary, such as a bank or a financial institution, there is a risk if the bank goes bankrupt, the money deposited in that bank might be, even though it is your money, it might be at risk. Wherein a money held in digital form within your wallet has no risk at all. Right? It can be stored in digital wallets, smartphones, or computers. So there are many use cases. We will look at those use cases also. It is very easy to use for shopping, bill payments, money transfers, etc. Issued and controlled by the central bank for security and reliability. May leverage technologies like distribute ledgers and smart contracts. And the BIS actually defines this as digital liabilities of central banks, widely available for public use as a medium of exchange, right? So there are many use cases for CBDCs: in-store payments, online shopping, peer-to-peer, government-to-person payments, right? You have disaster relief payments, international remittances, and in some cases, there are certain pilots for offline payments with CBDC. You need not be on a network or an internet. You don't need an active internet connection. You can use the CBDs for offline payments also. Some that we have encountered in our research are various such initiatives, right? And metaverse payments, right? The one that caught our eye is micro payments, like subscription for a news magazine or to read a news article. Such micro payments are also possible. What is under our scope of discussion is the business to business payments, where there is instant settlement and there is also a reduction of supply chain delays. Right? This is one of the major use cases that we are looking at right now. So if we use CBDC for trade finance transactions, so far in the examples where my colleague was explaining, like for example, in the case of our own bolt and nut manufacturer and the buyer who is from London, right, Templeton Boilers, how do we instill the trust between these two parties? The role of the bank actually instills that confidence between the two parties, right? The bank stands as guarantee on both these parties. So it is bank versus bank dealing. In fact, what we mean to say is my customer with your customer. My customer is trying to export. So please collect money on behalf of your customer, pay us, and please abide by the terms of contract. Since there is involvement of banks, the trust is instilled. Now this could be a little bit interesting in the case of CBDCs, because the CBDCs are directly being issued by the central bank. Unlike the regular money, which is supplied through a network of banks and financial institutions into the economy, CBDCs can be infused directly into the economy without the role of banks. Now, how do we instill a trade instill trust in a trade transaction where there is no banks involved in the exchange of goods itself? Can that be done? And trade finance is all about intermediation. Now, disintermediation, how can this work in a CBDCs kind of a scenario? So, for example, CBDCs there are certain benefits that we should weigh in before getting into that deeper and wider subject, right? So what is the primary feature of CBDC in any trade finance transaction? It could be fast, automated, rapid settlement, use of smart contracts, all those things, right? So Bank of China, during its pilot programs, has recorded milliseconds in payment and settlements instead of 3 to 4 days, T+2. Those jargons of T+2, T+1 is gone, right? CBDCs can eliminate that completely. Cost reduction and support, right? Lower fees, reduce costs. In fact, most of these CBDCs, the blockchain networks, are contemplating a free of charge cross-border transaction, right? 6 to 7% of each value that gets transferred between two different countries, the intermediaries eat away them as fees, right? So this is something, could be a thing of the past. It is as good as sending money, just like you send emails, just like the air mails, which used to charge a bomb to send 150 grams of paper from one country to another country, where the postal department became defunct, right? In exchanging information, emails have replaced the postal department and made it practically free of cost. Similarly, can there be a way to send money and send and receive money without any charges? Absolutely nil charges, or near to nil charges. That is also possible. And this is also one great example where financial aid can be provided for a weaker supplier. Let's say today there is barriers of entry in trade finance. If you are a small supplier, say some upcountry, you will have to, if you have to directly trade with Walmart, right? It could be a humongous task. So the current scenario is you will have to directly go to a supplier who the Walmart trusts, sell the supplier at a reduced rate, and the supplier would be skimming off the trade for the produce that a small supplier would be making, right? So this business can be reduced, and also Walmart can be equally apprehensive. Why paint Walmart the bad guy? Walmart doesn't want to source through opaque supply chains. Now, what if he is a small player, small supplier who is engaging in child labor, sweatshop conditions, unethical work practices, unethical labor practices? We are seeing this a trend in many of these developing countries where these big corporations trade with. Such opaque supply chains can also be eliminated. Security and transparency, convenience, experience, risk and mitigation, business integration, and innovation and integration are some of the major themes of CBDC and the trade finance interplay itself. This is one of those POCs done by the case studies which is available out there on the internet, done by the MAS, Monetary Authority of Singapore, where a Thai buyer wanted to buy from a Singapore seller. So these sequence of events and the exchange of money can happen in milliseconds. The only thing that would delay is the shipping time, right? The actual shipping time is the only delay, wherein everything else can happen, execute without any preconditions. And mind you, unlike a traditional trade finance transaction where the intermediary such as banks are involved, this is completely disintermediated by a bank, because the Thai buyer and the Singapore seller can directly trade without the influence of banks. Now, there is also a combination, right? CBDC combination and the financing combination, which is also possible, where a financial institute or a lender can actually fund the buyer. This is also one of those use cases. So I would like to, I know we have already overshot by a few minutes, and let me spend this time, which is very profound, which has left a very profound impact. And we have seen many digital payment infrastructure success stories around the world, mostly developed countries, underdeveloped countries and all. This is one particular great study, and I think this is something profound which has happened and we have stumbled upon our research as well. So we are talking about Cambodia. So an oppressive regime called the Khmer Rouges of certain political affiliation decimated their monetary system. Thereby, the locals lost their confidence in their sovereign currency, which is the real, right? So due to this economic turmoil, and the United Nations introduced dollarization to ensure price stability, and there is no loss of value for the goods exchanged for a price, right? So that is something that UN has introduced. Since then, the entire Cambodian economy shifted to dollar usage, and the usage of the sovereign currency itself has become has diminished, right? The government, despite its various efforts, it couldn't do that, right? So then the National Bank of Cambodia, which is the central bank, taken certain steps from 2016 onwards, and they selected the Hyperledger Iroha blockchain platform, right, for its digital payment infrastructure. Mind you, Cambodia still doesn't have a CBDC till date, or in the plans of releasing the central bank digital currency, right? It's not there. But however, that digital payment network uses the DLT technology platform, right? Suramitsu, a company, Japanese company, along with Hyperledger, they implemented the system, and there are certain future plans. And the central bank governor, in a very passionate speech in Singapore, he was saying how the distributed ledger platform has digitized the local economy with digital payment network. 75% of the transaction amounting 75% of the GDP is being traded on this Bakong blockchain, 50% being USD, 50% being the local currency. The currency sovereignty is regained, right? This is the power of a digital network, digital payments platform. We, of course, Indians, we have tasted it in great detail in the form of UPI. But what is very, very profound is Cambodia has the infrastructure ready to accommodate a CBDC, right? In fact, the most of the expats are working in and around the neighboring countries of Cambodia, where a lot of cross-border remittances happen. China, Indonesia, Singapore, right? Most of the Cambodian expats stay there, and they are in the verge of getting these bilateral agreements, which we will look at this. This is part of the conversation that we would like to have in the challenges and consideration. So regulatory frameworks is a major challenge, although these countries are in various pilots. Regulation, how do we regulate this? For example, a person who is exiting a port of entry cannot take more than 25,000 US dollars in India, right, as currency, right? Any port of entry, right? If you take a bar of gold out of a port of entry, the customs officer can grab that gold without questioning it, who is the authority, and you will not be allowed to take it outside. Similarly, stands for currency also. Now, if it is in case of CBDC digital currencies, right, that is something, how do we manage that? That is one of these challenges. Second major challenges is disintermediation itself, right? The world runs on fractional reserve system. What if we say we don't need banks anymore? What happens to the cost of funds that the banks borrow and provide easier access to credit? It can decimate the system. There are certain regulations like like you can have a remunerative CBDC, non-remunerative CBDC, how much of the CBDCs that you can hold in your wallets, how much do you have to hold it with the intermediaries. These are some of the regulatory frameworks that is being under consideration. Like for example, in trade finance, the e-bill of lading itself, how do we standardize the bill of lading, right? What is the structure? Now, the bill of lading, you cannot write it on a piece of paper saying that bill of lading, right? It should accommodate the uniform customs and practices that is being devised by the ICC, UCP 600, various regulations are there. So how do we have these regulations for a digitized paper, right, for trade finance? So these are certain regulations which needs to be thought through. Although the technology is there, the POCs are getting proved. So there is a lot of thinking and how this would, like for example, 80% of the export is done by the BRICS country, right, of the world export, but the major buyer buys in US dollars. How do we, some countries, I don't want to get too political, some countries would like to eliminate the dollar hegemony, and some other countries would like to retain dollar as the medium of currency for international trade. These are various push and pulls by various governments. So there is a need for regulatory compliance and interoperability issues. That is a major issue. Like there are many networks, many blockchain networks, many technology companies. Some are private blockchains, some are public blockchains. So if I am part of a public blockchain and I would like to communicate with somebody who is part of a public blockchain, can I do that? Or how do I do that? So will the smart contract will be recognized across all these networks? Will there be a unified standard, right? So these are interoperability issues which many of these blockchain technology companies, that is a major issue. So if you look at the top two issues which come up when it comes to CBDC, blockchain and trade and everything, one is the regulatory framework, second is the data and privacy, and the third one is the interoperability issue. And like I said, there is no unified industry collaboration. Just in the case of ICC, right, they have come up with standard